Hi, I'm Doug Heilman. I've been involved in the sustainability field, or ESG as we call it now, for a long time. About 20 years ago, I wrote my first sustainability report. I was also in-house at a Big Four firm at the time and supported an internal audit engagement. And I also supported financial audits as a subject matter expert in the environmental field. It was interesting as an engineer, MBA, working at an accounting firm to learn accounting rules and see how accountants see the world. Sustainability reporting and ESG reporting has just exploded. In the recent publication of a proposed rule by the SEC, by the ISSB, and numerous other entities have all increased the interest in sustainability reporting. As I've worked all sides of the situation, writing reports, auditing reports, developing compliance programs, risk registers, and the like, I've noticed there are three attributes of sustainability reporting that are really different from financial reporting. And as sustainability specialists, whether you're in HR, environmental, procurement, quality, operations, whatever, you will be talking to accountants more in the near future about sustainability reporting. And I would suggest that accountants will be talking to other subject matter experts as well. So it really helps to understand how they're different so we can all get on the same page. So what are the three attributes? Well, the first one is the difference between control and influence. Financial reporting, if you consider an income statement or balance sheet, it's about what the entity can control. The entity controls its sales. It controls its operations. And everything included in the report is pretty much involved with what the organization controls. In sustainability reporting, organizations are expected to report on their control and influence. I noticed this for the first time in the mid-90s when ISO refreshed their ISO 14001 Environmental Management System standard. They made it clear that in order to get a certification, an ISO EMS must take a life cycle perspective. They must look upstream of their organization and downstream into how their products or services are used and disposed of. They said that that was the intent of the standard all along, but they really raised the profile of it so that companies would be required to influence or to at least know what's going on outside their four walls to get an ISO certification. Sustainability reporting includes many things where companies must get information from their supply chain on product conformity, conflict minerals, Scope 3 emissions, and human rights, and the list just keeps growing. And if the company does not get that data or exert influence and to encourage their supply chain to perform better, the company may be called into account. The same thing goes with the value chain. How are companies encouraging useful stewardship of what they sell to their customers and put out in the public domain? So that's one difference, the difference between control and the expectation that companies report on their influence in sustainability reporting. The second attribute is the difference between quantitative and qualitative information. Financial reporting includes a lot of numbers, and accountants are very interested in numbers. Investors are very interested in numbers. We're all very interested in numbers. What were the sales? What were the profits? What's the balance sheet? What's the assets? What's the liabilities? There is narrative to support it, and there is narrative in other SEC filings. But I would suggest that in sustainability reporting, there's a lot more narrative. Companies are expected to report and disclose their processes for sustainability risk assessment, how they engage with their suppliers, the results of corrective actions from prior reporting periods. So there are many things that tell the story about the governance at the board level, at management level, describe commitments. It's not marketing fluff, it's narrative that investors and other stakeholders rely upon. And you just can't say something, you have to have the goods to back it up. The third attribute I would suggest is that sustainability reporting is about past performance, and it also is much more about looking to the future. The whole point of sustainability is to ensure that we have a planet and that we have a future. So reporting is a pull, if you will, from stakeholders to get companies to disclose and to report on what they're doing to meet the needs of future generations. Whereas an income statement is a backward-looking reporting period compared to other reporting periods, and a balance sheet is a snapshot in time, sustainability reporting is expected to include goals, targets, what the company's campaigns are, and what the organization expects to do in the future. And companies are really setting the stage for their own report card for years to come. So these three attributes do set up a bit of a quandary for companies doing these reports, writing the content, developing the procedures and controls that go with it, and doing verification audits or even assurance readiness. When it comes to control and influence, how do organizations control what they don't control? That's a problem, but companies are finding ways to do that through documented processes. How do you audit narratives? How do you support what has been stated? That's another problem, but companies are finding that they do have to be careful about what they say, lest they get accused of greenwash, or even worse, if they make statements that are knowingly deceitful and could be considered fraud. And the third attribute, the forward-looking content, does pose a problem for an auditor or a risk manager. How do you audit a promise? That is a problem, but promises can't be empty. They have to have programs, resources, commitments set up to support them, and companies need to remember that they will be held accountable to report on the progress to those forward-looking statements in the future, whether there's a safe harbor provision or not. Your stakeholders will hold you to account.